The biggest stock in the world just reported earnings, and Apple was down 3.42% after it reported its second quarter earnings. Now, we're going to talk about why Apple saw this move down, what it means for your portfolios if you hold the S&P 500 or if you hold the Nasdaq 100. We're going to talk about, is this sell-off justified? Does Apple's new earnings mean it's a buy? And we're going to look at our overall valuation framework to determine if you should buy Apple now and where the stock will go next. But before we do that, could you please go ahead, like and subscribe? It really, really helps a small channel like mine out. Let's dive in. Now, looking at the headlines, Apple reported a double beat on both the top line and the bottom line, growing revenues 5.1%, reporting $95.3 billion in revenue and earnings per share of $1.65. The company refrained from giving guidance, but the quarterly numbers were really, really good. Growing EPS 8% year over year, growing 5.1% year over year with a 3 billion user installed base. That is just insane. So to still see year over year growth is actually something to behold. Looking at the margin profile of the business, we saw gross margins expand. We saw EBITDA margins expand. We saw free cash flow margins contract. And that has to do with some of the CapEx spend. That is actually a theme we've seen in the mega caps. However, free cash flow did actually increase on a quarter over quarter basis by about 1%, call it 200 million. So while margins did decrease, the nominal figure of free cash flow did increase. EBITDA income did increase to $32.2 billion, and the company sitting on quite a lot of debt, but also a substantial amount of cash as well, 136 billion in cash. About half of that is pledged against the debt that they have on their balance sheet. So when you look at these figures, right, growing, let's say mid to high single digits on the top line and bottom line, margins expanding, except in free cash flow, but the nominal figure increasing. Why was the stock down 3% here in the extended hours? Well, it had to do with some of the commentary we got from Tim Cook. He said a couple of things and the market just didn't like that at all. He expects tariffs to add $900 million in costs in the upcoming quarter. The Apple management also declined to give any forward guidance, citing trade uncertainty. And I think these are the two big reasons why the stock actually sold off. The board of directors authorized an additional $100 billion in share repurchases. This came under the street's expectations, and also last year's authorization was $110 billion. So Apple probably wanting to save a bit of cash, a bit of cost control with regards to those buybacks. And then services actually missed Wall Street's expectations. Year over year on a quarterly basis, it grew 11%. I think the street were looking for around about 12.5%, 13%. And then on a trailing 12-month basis, services grew 23%. I think the street were looking for about 25%. And because of that, the stock sold off. China sales also missed Wall Street's expectations, and Apple declared a dividend of 26 cents per share, an increase of 4%. I think the street were looking for 27, 28 cents. And so, missing these street's expectations, the stock is going to sell off. So you can see a net sales on a year over year basis grew 5.1%. Total expenses grew 4.1%. But the reason why net income only grew 4.1% and not significantly higher, despite the operating leverage the company managed to build in this last quarter, was because operating expenses increased 4.4%. And that has to do with the higher cost of research and development as well as SG&A. However, net income still grew 4.1%. And with the share buybacks, you were able to see earnings per share growth of about 8%. Now, breaking down the geography per segment, you can see Europe only grew 1.3%. This is the second biggest segment behind America. China sales actually fell 2.2% on a year-over-year basis. Now, the reason this is significant is because Europe and China together make up the same amount of revenue as the Americas, right? And then these two segments together roughly were flat on the year. The American segment growing 8.2% with a 16% increase in the Japan segment. That is how you get your 5% increase in total net sales. We saw great performance in the America segment, the Japan segment way down by Europe, China. Looking at net sales by category, iPhone was very, very sluggish, only growing 1.9%. iPad and Mac, due to the refresh cycle we're seeing right now, saw an increase of 6.6 and 15.6% respectively. Very, very strong growth in both those segments, particularly the iPad segment. And then services was up 11.6%. Double-digit growth, very, very solid there. However, the Mac iPad, wearables, and services simply cannot make up for the sluggish growth that we saw in the iPhone segment. The iPhone segment makes up about half of total net sales. So you can see here that until the iPhone sales are actually reinvigorated, until we go through an iPhone upgrade cycle, it's very unlikely that we're going to return to double-digit growth from Apple unless the services segment can become significantly bigger than what it is right now. That being said, this company still technically firing on all cylinders. However, there's a lot of underlying issues that you do need to be aware of. I think the things you need to watch, number one, is just their segment sales, right? You want to see if iPhone sales can re-accelerate. Can Apple increase prices? Will we get an upgrade cycle soon? We've been talking about an iPhone 16, now iPhone 17 refresh cycle, thanks to AI. If Apple can really commit and bring something special in the AI space, you'll see that refresh cycle, and that will be a boom for Apple stock. Looking at the second thing you need to pay attention to is regulation. The FTC is going at these big tech companies, particularly Google. Google pay Apple about $20 to $25 billion every single year to be the default search engine. If that goes away, that is going to weigh on overall growth as well. So you need to pay attention to what's happening with Google, Meta, and all of these regulatory bodies. Number three, tariffs and excess costs that Apple will incur. And then the fourth thing you want to look at is their debt, right? I still think they hold a lot of debt on their balance sheet. Maybe I'm a bit conservative, but these are the things you want to watch. I think Apple's moat continues to be wide, probably the widest moat stock in the world, in my opinion, and it is unchanged, even though we are seeing growth in the mid-single digits. Again, it just goes to show how core iPhone is to Apple as a business, and the Apple thesis is intact. Right now, when you invest in Apple, you're looking at a company that's going to grow mid-single digits with segment upgrades coming in cycles, but essentially, you're going to get a good dividend. You want the company to buy back stock, organic mid-single digit growth, and you're just going to have a very, very long-term compounder with, in my opinion, an unbreakable moat as it is right now. Looking at the valuation of Apple, it trades at a very, very lofty valuation. EV to EBITDA of about 20 times, price to earnings of about 34 times. At its peak, nearly 42 times. So that has come down significantly. An Apple shareholder yield of about 4%. That includes debt pay down, the dividend, as well as the buyback. Now, what returns can you expect from Apple? And we just go through our normal framework. We plug in the revenue growth, consensus revenue estimates, as well as the margin profile of the company to get a terminal 2029 EBITDA number. So that's $190 billion a year for Apple. If you look at 7% revenue growth and 34% margins, we're going to apply a 20 EV to EBITDA multiple. That is the current EV to EBITDA multiple, right? So we're not seeing any multiple contraction or expansion. Then we subtract the net debt to get the equity value, divide by shares outstanding, and we're looking at 1% sequential share decrease every single year. The 2029 stock price is a smidge under 270. Current stock price, it says here 213, but it's closer to the $200 mark. And then if you add the 0.5% dividend yield, you're looking at about a 5% compounded annual return, maybe closer to 6% after today's move. And so I would say Apple is not a buy right now. I would want just a little bit of a discount. However, if we do get an iPhone upgrade cycle in 2026, 27, you could be looking at, anywhere from 10 to 15% growth in one of these years, and that could substantially increase the projected return for Apple. That being said, when you look at everything very linearly, 5% compounded annual growth rate, I'd rather just buy the S&P 500. Now, looking at the technical charts for Apple, we're kind of in this limbo zone right here where we found support at the 170 area, but we're not above the 200-day moving average, and we're still well below the highs here of Liberation Day. So I wouldn't really say that Apple is screaming like a technical buy at the moment. If we broke some of these highs, then maybe if we're above the 200-day moving average, then maybe. If we're maybe here at the lows, you would say, yeah, you could look for a turnaround play, but it's in limbo right now, so nothing on the technical charts. So I would not buy Apple right now. It doesn't look technically sound. The technicals don't look that great. The valuation is a bit pricey. The returns over the next 5 years don't look super great. I love the business. I love the stock. I would buy it at the right price, no question. It's just that at 20 times EV to EBITDA or 34 times price to earnings, it is not at the right price right now. But if you've made up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.